Most people think that when it comes to iron condors, wider is better, but that may not be the case in this market. Welcome to the 12-Minute Trading Market Minute for Sunday, the 9th of April. Let's start off by defining what an iron condor is. An iron condor is where we set up a put credit spread below the market. And so in this case, we're going to sell an out-of-the-money put credit spread, and that's also joined with an out-of-the-money call credit spread. Each of these creates a credit, and it's a four-legged trade, which brings in a certain amount of credit at the beginning of the trade, and our goal is to defend that credit, and eventually our intention is to close down the trade before expiration and keep as much of this credit as possible. That's the good side of this. The dark side of this is that potentially if the price moves a lot, then this is our risk down here. Our risk can be quite steep. If we're looking to only make a 55-cent credit or $55 per contract, then the risk on this trade actually can be as high as $945. And that is irrespective of the direction that it eventually goes in. So if we rally super hard or if we sell off really strong, then we could potentially be looking at a significant loss versus the potential profits of this trade. A lot of retail traders set these up at 0.05 delta, so a 5 delta option on the short options, so both on the calls and the puts. And so if we look at the probability of that, that's a 95% probability times another 95% probability. And so the overall probability of the trade usually ends up being at something around 90% probability of success, that the price is going to close somewhere within this range. And in this case, this is going to be above that short strike price at 39.15 and below the short strike price on the call side of 42.55. So you might look at this and say, man, there's almost 350 points of room on this trade, so the price can trade within this huge range. And so what's the problem? The problem is that you don't know when a price excursion to the upside is just going to stop there and maybe pull back, even though it's maybe overbought, or by the same token, a price selling off might be oversold, but you don't know if it's going to stop at this level and give you relief and bounce back again, or whether it will keep on going. And so usually all it takes is one or two of these over your trading career where you get run through. And to make matters worse, if you're trading something like the spiders or the IWM or some kind of other American settled instrument, you actually get assigned the stock on a price excursion because your short puts are in the money and you get exercised on those short puts. So usually it takes about one or two times in a trader's career of actually being run through like this, whether it's to the downside or to the upside, where you say, hey, I don't want to ever have that happen again, because this is where you're literally throwing away the profits of maybe 20 straight successful trades and throwing them all away and going back to zero. It's kind of the old Sisyphus rolling the ball up the hill and then only to roll all the way back down again to your starting point, or maybe even below that. To make matters more difficult lately, and this is why I'm talking about this trade today, is the fact that we now have an implied volatility percentile of 0 on the S&P 500. So what that means is that over the last 252 trading days, if we rank them from 0 to 100, with 100 being the highest implied volatility that we've seen over the course of the last year, which would be sometime back here, if we rank that versus the lowest implied volatility that we've seen over the year, guess where we're at right now? We're down here at 0. So this is a relative low of implied volatility. And what that means for option traders is that we're trading less range. We're trading less range. There's less implied forward movement that is being priced into the option chains. But even though we have very low implied volatility relative to last year, we're still getting these major price swings that are literally coming out of nowhere. This swing tacked on almost 200 points in only 6 trading days. So you can see on this particular strategy, if we have another one of these 200-day wonders that tacks on 200 points in the space of 5 days, this trade will be in trouble to the upside, maybe even to the downside. So if you're an iron condor trader, what can you do to resolve this problem, this issue where you put on trades that just don't have the amount of distance necessary to contain the market's current volatility with where the forward pricing is in the option chains? One of these solutions is technical. The other solution is structural. First of all, the technical. What I've got here is a monthly, weekly, and daily chart of the S&P 500, and I've got these arranged with fractal time frames and also with our fractal study here, which is essentially the choppiness index set for a period of 9. This gives a relative, I guess what I'd call it as a fuel gauge on the market. So whether it's full or whether it's empty. Now, when it's full, this is where we're likely to see big trends spring from. This is where the price is wound up in nonlinear action. It's almost like a spring coiling up, and this is where we expect to see big trends springing forth from. Now, when it's empty down here, when we have a high degree of linearity behind this recent trend, this is where we expect to see exhaustion and the transition from range expansion to range contraction. So this is where we want to be looking to establish trades when we have low levels of energy and the price is unlikely. I won't say will never, but there's a much higher probability that the price will not continue trending in that direction. It will stop to pause, consolidate, and go into non-linear. So again, just back and forth between range contraction to range expansion. We want to look out for these range expansion areas, and we want to be aggressive when we get the price into a range contraction area at exhaustion. So these are the areas that we want to look to be aggressive in when we have exhaustion. And similarly, this is the area that we want to be careful of where we have a high degree of energy and a high likelihood that the price will spring out in one direction or another. We don't have to calculate or predict the direction. All we have to do is slowly back out of the room and avoid getting run over. So that's the technical solution here, is to not trade this strategy when we have periods of high degree of energy where we would expect to see a large excursion coming out of this price consolidation in one direction or another. Again, we don't have to predict which direction it's going to come from. We can just let it unfold and slowly back out of the room when it comes to those times where we see high energy and high likelihood of seeing some big movement. And if we really want to, we can play the inverse iron condor during these times. If we're expecting big movement, we can simply play a long iron condor for a short period of time. Now, the second thing I said that we could do to fix an iron condor like this was more structural. So versus technical, what we talked about with the charts. Now let's go into the structure. So again, this is a high probability iron condor structure with about a 90% probability of success that the price will end up expiring inside of this range. And I think you can see ways that you can better time your entries for these, or avoid entering during times where the market's probably going to rip one direction or another. And that's the thing about being an iron condor trader, is you're unhappy with any kind of movement, regardless of which way it is, whether it's going up or whether it's going down. You're unhappy if you've got movement. So that's kind of the blessing and the curse behind these iron condors, is that they're great because they're range bound, but only when the price is acting range bound. So the other thing that we can do to fix these during low volatility markets or low implied volatility markets is the structure. So what we can do instead of going high probability is that we can go low probability. We can actually collapse the sides in. Now, this is not intuitive, A lot of people will say, what on earth are you doing? Why would you make it more narrow? Well, this is purely about two things: risk and reward, number one, and number two, time decay. The closer that these short options are, the more extrinsic value that you do receive. So you get a much, much bigger credit. So instead of getting a $55 credit, we're talking about $250 out here. Instead of looking at a $945 loss, your maximum loss is $250. So first of all, if there is a black swan event in one direction or another, I'm not that concerned about it. I don't have to wake up at 2 o'clock in the morning and check the futures to see if there's some kind of overseas event that just happened, which is going to blow out my portfolio. So the first big advantage is risk management on black swan events that you can't do anything about, right? If we get a 7% limit down, circuit breakers fire, and then they open again later on in the day, circuit breakers fire again, we're down 14%, we're down 20% in a day, I don't care, right? So I've written off the 250, I can deal with that, but you can only write off so many of those $945 per contract before it becomes a real problem. Now, the second thing this is good for is small accounts. So think about this for a second. On the high probability, if I'm going for, let's see if I bring in $50 of credit, and then I want to exit early, and so I would hopefully be able to walk away with something like $25 of profit, or maybe 2% of the return on risk. And that's after a couple of days. So again, that's not a bad thing. That's not a good thing. It's just, that's the math behind the trade, is you're going to earn about 2% on a trade like that. Now, if I trade this within 2 days, if I pull in 250, walking away with 10% return on risk is very, very real for a trade like this. So 10% return on risk. These trades are just much faster. You're dealing with so much more extrinsic value, which is going to erode very quickly. So even if I catch a trade like this in a very short-term consolidation of about a day, then I can make my fair share and be out of this trade before the price starts to swing again. So again, the key to success in trading these days is two things. It's technically, it's waiting for the price to show you a high probability of range contraction in the next couple of days, and we're going to use the fractals to determine that. And then number two is to change our reward to risk on the trade so that we're not risking as much and getting run over by the next trend. If the market changes, then we have to change with it, and we're going to adapt, improvise, and survive through this next run. That's it for today's Market Minute. Thanks for listening. We'll talk to you soon.